Hey guys, after the 2008 crash, the world of multifamily real estate has exploded, mainly due to the low cost of capital by lenders and by individuals flush with cash. Sellers of multifamily understand that all this cash is looking to be put to work, and this is driving prices to all new heights around the US. Reports published by the Black Creek Group show that in the 54 MSAs that they monitor, they're currently in or about to be in hyperinflation. So all this means is that many of these areas are just overpriced. And this explosion is not just limited to appreciation markets like New York or Los Angeles, but also to tertiary markets alike. My partners and I are really just shocked at some of the prices that are being asked for some of these apartment deals. Some of this heated market is commercial brokers inflating prices to get an institutional or a foreign investor to overpay for deals. What's more, many of these people are coming to the table up front with like non-refundable deposits before the due diligence, plus a 15% premium. And bear in mind, this is for C-class portfolio stuff. Where typically in an area that might be at a 10% cap rate, they might pay a 5.5% cap. Now, this is very worrisome. Unless they're just parking money, but it's going to be very hard to get a decent return on that investment. To me, it seems that these investors are going ahead and overpaying for deals, and they're ignoring the fundamentals of the business, such as cash on cash return, cash flow, and ROI. But why are they doing it? So here are some possible reasons. Number one, the individual investors have 1031 exchange funds that need to be put into real estate to avoid being taxed by the IRS. Because there is such a tight time constraint of getting those funds, those 1031 funds, into another real estate deal, they're willing to take a slightly less return than have it being stolen by the IRS. Number two, institutional investors are lowering their bar and going after smaller deals. They used to just look at deals exceeding 250 units. Usually they played to 500 plus units. There are so few deals out there that now they're going after smaller deals, and they're willing to take smaller returns just to get their cash out there. Number three, out-of-state investors are not seeing the returns in their local markets because the respective markets are way too expensive. They look to the Midwest and are attracted by the cheap cost per door. International investors want to put their cash into a stable and strong US dollar, and they see the same cost per door as an easy way to get into the market. In both cases, they're still paying a premium, as the buyers in the local market won't even touch a deal like that. Number four, buyers and syndicators believe that all markets appreciate, and they'll sacrifice a lower return for what they believe will be a huge boost in the sale price down the road. This is not the case in many markets. There is nothing wrong with buying for appreciation, but people need to understand what they are buying in those markets. Number five, buyers and syndicators are bending their conservative rules and taking a reduced cash flow and returns to get into a deal. They assume the market will continue its climb for the next 20 years with no economic disruption, and while tacking on rent increases of 4 to 6% a year in their financial models, which is just not feasible long term. Number six, when these same buyers and syndicators perform their underwriting, they assume that the bank interest rates will be as low as they currently are, 5 years from now. If you look at the trend of the federal funds historical chart, it's on its way up, and I'm betting it will continue to climb. So I would not bet that you're going to see a 5% rate in 5 years from now. I really don't see it. Number seven, that broker on LoopNet actually returns a buyer's call and tells them they have a sweetheart off-market deal that they just can't pass up. However, they need to pay top dollar to win it. So they accept the broker's pro forma as truth and they buy the property. And that broker then takes that comp and puts it into the next deal that they're peddling and say, look at this. This deal that is selling for $45,000 a door in a $30,000 market. So I'm not saying that anyone making deals today doesn't know what they're doing, or that any deal trading today is overpriced. The buyer may have access to an off-market deal, or there is a true value-add play where the rents are 30% below market and occupancy is at 78%. In this case, you and your team are adding value by stabilizing the property. Regardless, the investors in these deals make sure that it meets their minimum investment criteria and they do not deviate. They also adjust the model to the work involved to stabilize it to the level of risk. Now, I'm a believer in buying for cash flow. My buyers and I, we stick to the numbers and leave the broker's opinion and their pro forma out of our decision-making process. Unless you're getting into a big turnaround situation like I described before, your best bet is to apply conservative underwriting to your deal based on actual performance. If your deal performs well and you can still build in reserves while still satisfying your investment criteria, then you need to take that deal down as quickly as possible. This means you'll be able to, you're going to have to analyze boatloads of deals just to find one that'll work for you so you don't crash and burn on that deal. Anyway, is there any situation where you think it's okay to overpay for a deal? How and when would you do it? Let me know in the comments. I'd love to hear from you. And if you like this content, please go ahead and give it a thumbs up and share it. Also, check out the Bulletproof Cashflow podcast on iTunes and Stitcher, and subscribe to the YouTube channel as well. If we're working on getting new content to you guys out all the time and helping you build success in the world of multifamily, be great, guys, and I'll talk to you soon.